Live from New York City this morning. Good morning, good morning. Let's get you to the weekend. Three-day losing streak on the S&P. Equity futures trying to bounce. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, Google preparing to cut 6% of the global workforce. Senator Mitch McConnell says the U.S. will never default, and top Fed officials determined to stick with high rates. We begin with a big issue, the Fed's last word.
We have a Fed here who's not backing down.
They're very concerned of being the Fed that paused too early.
Some speakers, members being fairly hawkish, some less so.
Inflation is on its way down. The economy is slowing.
We hope that the Fed will engineer a soft landing here in the U.S.
This has the signs of being a soft landing.
We think that you're going to get a recession.
But the jury is still out.
We have amongst investors a very, very different view.
We're in the don't stop camp.
We're more in the stop camp.
Maybe another 50, 75 basis points certainly does the trick.
We think 25 more basis points.
The Fed needs to get truly restrictive. I agree with Bullard on this.
Lower terminal rate, staying there for longer.
Just a fantastic lineup this morning, and I'm pleased to say we kick things off with Mohammed Al-Erin of Queen's College, Cambridge, and Bloomberg Opinion. Mohammed, fantastic to welcome you back to the programme after about a month, so thanks for coming back, sir. Let's start with this 25 versus 50 debate. Are we ready for that downshift all over again?
It's a really tricky one, John. There's good arguments for both, 25 or stay at 50. There's support from data, depending on what you look at. If you want to go to the 25 camp, you look at the retail sales numbers, you look at the curve inversion. The 50, you look at the labor market, and there's downside risk to both. So it's a really interesting debate. I'm not sure there is the right answer. And then you have to factor in what the market is pricing, which is not what the Fed is telling us, and the credibility issue. I think if you put all that together, I would go personally for 50. And that's because I think inflation is going to get sticky in mid-year at around 4%. And I'd rather get the tightening out of the way now than when the economy weakens. But it's tough. It's a personal judgment. I'd go for 50.
You would typically break this down as pace versus destination. So this is about pace. Does the pace tell you anything about the ultimate destination?
It doesn't. The ultimate destination itself is a variable. The real question is, do you want to link the pace to the destination, where some people are tempted to do that? Say, go slower, but go for longer. I don't think that's a good idea. I think that if you look at the two-sided risks of that approach, I think it tilts too much on the downside.
Back in June 2022, so last summer, I remember the article you wrote in the FT, and I brought it up this morning, and the headline was "The Risk of Flip-Flopping." And you wrote this: "There is a danger of the classic stop-go trap that haunted many Western central banks in the 70s and 80s. Mohammed, do you think that weighs on them?
Oh, it absolutely weighs on them. Just listen to what Chair Powell says over and over again, as well as other Fed officials. It absolutely weighs. They do not want to be remembered as the central bank of the 70s that made that mistake. And that's why they are maintaining a hawkish narrative, even though the market is not listening to them. It's very strange, John. You know, I grew up when the paradigm was forward policy guidance mattered, and the markets really listened to forward policy guidance. Here we've had one Fed official after the other repeat the same message. We're going to 5 and above and staying there, and the market saying, I don't care.
Do you think that's a credibility issue?
I think it is a credibility issue, and I think it is also a market conditioned by a Fed that has always tilted dovish whenever things got difficult.
Well, things are getting difficult right now, and let's think about how they're approaching it. We heard from the Fed Vice Chair yesterday, and really President Lagarde echoed what she said already. We heard this from Brainerd: we're determined to stay the course. We heard this from Lagarde: staying the course is my mantra for policy. What was interesting about the speech, if you read the body of the speech, thinking out loud was a phrase that Kit Dukes of SocGen used this morning. The body of the speech was thinking out loud about a soft landing. And there was this quote right here: it remains possible that a continued moderation in aggregate demand could facilitate continued easing in the labour market and reduction in inflation without a significant loss of employment. Now, traditionally, that's not how we think about this. Bob Michael of JP Morgan spoke to our team here at Bloomberg earlier this week, and he said the equation was simple. Inflation doesn't come down until wages do. Wages don't come down until employment rises. Unemployment rises. Unemployment doesn't rise unless we are in recession. Mohammed, which one is it?
So that's not the end of the thing, right? I mean, that's the trouble, is that the debate has stopped where you stopped. And because of that, you end up by saying we cannot have financial stability in terms of inflation without high unemployment. What about labor force participation? What about better skill matching? You know, we can get there. And had the Fed started earlier, the risks would not be as high. But let's talk a little bit about what else needs to be done. This excessive focus on the Fed means that we're not looking at things on the supply side that would resolve a lot of the uncomfortable trade-offs that we're seeing on the policy front.
Something we need to discuss more, something we won't hear more of after today is Fed Speak, and that might be good news for some of you. It is the final day before the quiet period, so the Fed Speak ends today. We're going to hear from Harker. We're hearing from him right now. We're going to hear from, a little bit later, from Governor Waller, and with Michael McKee, the Kansas City Fed President. Mike McKee joins us right now. Morning, Mike.
Good morning, John, and you're right. This is the last day for Fed officials to get their thoughts on the record before they make their next move on February 1st. Pat Harker, as you noted, is speaking right now. There's a tinfoil hat kind of theory on Wall Street that Jay Powell calls these guys into his office and says, here's the message, everybody go out and give it. They don't do that. They give their own individual messages. It's just sounding coordinated these days because Harker, like everybody else, is suggesting it is time to dial back on stimulus, but not to ease the overall pressure. Here's a quote from his speech right now. I expect that we will raise rates a few more times this year, though to my mind, the days of raising them 75 basis points at a time have surely passed. And he goes on to say, at some point this year, I expect the policy rate will be restrictive enough that we will hold rates in place to let monetary policy do its work. That's a very similar message to what we heard from the Fed leadership last night. You already mentioned Lael Brainerd, also John Williams, the vice chair of the Open Market Committee and the president of the New York Fed Bank, saying much the same thing. And they used almost identical language in laying this out. While there has been progress, both said, even with recent moderation, inflation remains too high, according to Brainerd. And with inflation still high and indications of continued supply-demand imbalances, it's clear that monetary policy still has more work to do. Now, Brainerd and Harker said almost explicitly they're looking for 25 at this meeting. Enough people have said that I think you could pretty much put that in the bank. But to get back to Mohammed and what he was saying, the market's just not listening. You look at the forecast for what happens this year ahead, and even with all this Fed speak, you have not seen much change in the market's view that the Fed isn't going to get as high as it thinks it's going to get. The question then becomes, how long can they keep wherever they get to in place before they have to give in? A couple more speakers today. As you mentioned, we are going to be speaking with Esther George at the top of the next hour. And we also hear from Chris Waller of the Federal Reserve Board of Governors, who has been hawkish in the past. So I would expect much the same message.
The last word before the weekend of the quiet period. Mike McKee, wonderful. Looking forward to the conversation a little bit later as well. Don't miss Mike's interview with the president of the Kansas City Fed. That takes place at 10 a.m. Eastern Time, around about 52 minutes from now. Mohammed, I want to come back to you. There is a disagreement here, as you've indicated, between the market and the Federal Reserve communication. At the centre of that, I think, is a disagreement over the way people look at the data. The Fed says they're data dependent. We need to talk about what data they're dependent on. If I look at the hard data, it's mixed. You've still got claims at 190,000. I look at the soft data, it's terrible. The ISM, manufacturing services, sub 50 in contraction. Mohammed, how much weight do you put on each?
So it's very difficult, John. It really is difficult. I think, what do we know for sure? And you should have asked Mike, why does he think the market is not listening to the Fed? Because I think Mike's insight would be really important on this. Look, what do we know for sure? We know inflation dynamics have morphed. It is no longer about food and energy. It is no longer in general about the goods sector. It's about services. And services are much less sensitive to monetary policy. That is a real issue. And that's the cost of being late, is that inflation moves to places that you cannot influence as easily. That is why we have three sets of disagreement, John. One is between the market and the Fed as to where our rates going to go and how long are they going to stay there. Second, within the Fed, yes, it's probable that we get 25 basis points, but it's not a done deal at all. There are some who favor 50, Bullard being an example. And third, within the market, when you ask people why are you pricing in cuts in the second half of the year, you get two views. You get the nice view because we'll have nice disinflation, and you get the ugly view because we're going to have a recession. So this is full of disagreement, John, because there's so many potential outcomes here.
One is positive for markets, the other one much less so. Mohammed, let's build on that. You said there were 4 risk factors a little bit earlier this week when you published for Bloomberg Opinion. Buoyant markets need to watch 4 risk factors. Which risk factor haven't you mentioned yet?
So the one that worries me, because it's low probability, high impact, as you know, is market functioning, is liquidity. And that one, thank goodness, hasn't been in play. I think the beginning of the year, and that's why I put that article out over the weekend, the beginning of the year, the market simply got too complacent about growth, inflation, and policy. They embraced a narrative which is a wonderfully comforting narrative, but a low probability narrative. And what we've seen this week is a readjustment of that narrative.
Doesn't China's reopening influence that conversation, Mohammed, and to what extent?
So you know where China's reopening influences the most, John, which is not being talked about except by 1 or 2 people, including the head of the Norwegian Central Bank, Sovereign Fund, is whether that creates a leg up in goods inflation later in the year when service inflation is still an issue. For the short term, this is a very messy reopening, really messy in terms of what's happening on the ground, COVID cases, the pressure on the health system. It's not a smooth reopening in any way. So it's not that demand is going to shoot up and everything on the supply side is going to be fixed. It's going to take a few months for that to happen.
Let's put a bow on it then. If they stopped hiking after the next meeting, do you think there's a real risk they'd have to start again in the second half?
Yes, absolutely.
That's a big problem.
Yeah, and that's why I'm in the camp of actually get more done now when the economy is still doing well. Otherwise, you may end up having to do more later when the economy is significantly weaker. And that would just repeat the mistake of 2021 and 2022. Let's not repeat that mistake.
What do you think the biggest spread is now between you? Between you and this Fed, or between you and market pricing?
That's a really good question, John. I don't think I can answer that question because I see many potential outcomes to growth. What I do know is if I was in the Fed and I would look at my mandate and I would look at the balance of risk, I would continue hiking and I would ignore the markets for now.
Mohammed, this was great and it's been too long. Don't leave it a month again. It's too long for us. Mohammed Al-Arian there of Bloomberg Opinion and Queen's College, Cambridge, one of the very best and a good friend of this programme. Equities right now on the S&P up 1/4%. The big debate continues on Capitol Hill.
America must never default on its debt. It never has and never will.
The debt ceiling conversation up next. This does not feel the back end of a shortened trading week at all, does it? We're down every single day this week so far. 3-day losing streak on the S&P 500. We're trying to bounce here, trying to snap that losing streak, up 1/3% on the S&P, and Nasdaq 100 up 0.6%. The opening bell rings. Switch on the board and get to the bond market. Yields look a little something like this on a 10-year. Higher this morning by 7 basis points to 3.46 in the FX market. Euro dollar, negative 0.2%, 108.14. I have to say, President Lagarde sounded a whole lot like Vice Chair Brainerd. Staying the course is my mantra for policy. 24 hours after hearing Vice Chair Brainerd say we're determined to stay the course. Crude earlier had a look at 81, back down to about $80.72 on WTI. We're positive there 0.5%. About 20 seconds into the session, equities look like this on the S&P 500, positive 1/3 on the Nasdaq, up 0.6%. One stock to watch at the open, Netflix, absolutely crushing subscriber estimates with more than 7 million additions in the fourth quarter, plus a big change in the C-suite. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, John. We're up around 6% on the stock, biggest jump since November. I'd love to say that, you know, the street, the analysts and all the investors are kind of digging deep into what the Reed Hastings move upstairs means, but I think they're probably zeroed in on the subscriber beat for the last 3 months of 2022. 7.7 million subscribers added above the estimate of 4.5 million, which also Netflix was guiding to. There was some limited discussion on the call and in the earnings statement about the impact of the ad-supported tier. Netflix said that they were seeing progress in it, and actually there is some evidence that cost-conscious consumers were lured in by the ad-supported tier, which could have been of benefit or additive to that 7.7 new subscribers add. And a lot of the sell-siders who are responding positively this morning flagged that. On the change-up, look, Greg Peters moves from COO to co-CEO. He has already been the face and leader of this ad-supported tier move. He has been the guy that's also been cracking down on password sharing, something that Netflix has been discussing and will now start charging for password sharing, which could be supportive for revenues this year, according to the street. Otherwise, Reed Hastings remains in the executive chair role. Ted Sarandos already really focuses on Hollywood, really focuses on content, but there was another promotion in Bella Bajaria, who jumps from global head of TV to chief content officer. Overall, given a lot of the challenges this industry is facing, Netflix seems well positioned, and they pledged to get their profitability sorted in 2023.
Ed, why is it so difficult to guess subs? The difference between the number and the estimate is like this wide, off the screen wide.
Yes. I don't want to get myself in trouble, Jonathan, but I'm pretty sure that Netflix guided quite conservatively. They have a history of guiding quite conservatively.
Sure.
And remember, they're going to suspend guidance going forward anyway. I think what was interesting from the earnings call is we're not going to get a number going forward anymore, right, which will do away with this whole problem. But they did give some sort of commentary around how actually first quarter will be a little bit softer than fourth quarter of 22. Second quarter might start to see improvements, etc. So we're not going to get that full forecast, but we will get a few clues as to what's going on. And either way, they seem committed to content. They seem committed to growth globally, and not just here in North America, but think about Latin America, Asia Pacific as well.
Ed, thank you. Stock's up about 5 or 6% in early trading, 3 minutes into the session. For those of you with a Bloomberg, pull up Netflix and then just quickly type ERN, go. And it will give you the surprise screen for earnings for Netflix. If you don't have access, I can just show you what I see. If you look at the price change after earnings, so up about 6% right now. The previous 4 earnings releases, the stock was up 13, up 7, down 35 and down about 22%. So that gives you an idea of how wild post-earnings Netflix price action turns out to be. Another day and another round of layoffs we need to discuss. Google announcing plans to cut 6% of its global workforce, roughly 12,000 jobs. In an email to his employees, the CEO echoing many of his tech counterparts, writing the following: "I take full responsibility for the decisions that led us here." Kelly Lyons, how many times have we heard that over the last few months?
So many, John. Alphabet is just the latest in a long list of tech companies announcing that they are pulling back on their workforce after expanding it so rapidly over the last several years over the course of the pandemic. Of course, that was boom times for big tech. We are not living in boom times anymore, which is why Alphabet is announcing the 6% cut, as you mentioned. That affects globally their workforce across all different segments of its business. Those laid off here in the U.S. will get at least 16 weeks severance as well as health care benefits for 6 months. But really, this is about the weaker macroeconomic environment that Alphabet is facing. It has dealt with the slowdown in its digital advertising business as well as its cloud computing division that is still behind Amazon and Microsoft, and its sales growth has been slowing for 5 consecutive quarters. It was just 6% last quarter. And of course, we're going to get the latest figures from the company when it reports on February 2nd. Our analysts here at Bloomberg Intelligence do say that the layoffs announced today could help offset some of the headwinds the company is facing and aid operating profit this year, help drive faster profitability in its cloud business especially, which is where the bulk of the headcount growth over the last 2 years came from. But Alphabet, as we started talking about, John, is not unique in this and trying to rein in costs as the economic winds have shifted. This is a familiar story that we've already heard just this week. Microsoft cutting 5% of its workforce, an announcement just days ago. Amazon began laying off 18,000 people. Salesforce, Twitter, Meta, Meta, the list goes on. All of these companies recalibrating their cost base because the reality just looks very different than what they've experienced over the last several years, John.
The stock right now up 2.6%. It's a major change, Kaylee. Thank you. The C-suite in Silicon Valley taking full responsibility for the recent tech austerity. Salesforce CEO Mark Benioff has said this: we hired too many people. I take responsibility for that. We heard this from Google's leader. We hired for a different economic reality. I take full responsibility. Amazon, we've hired rapidly over the last several years. The CEOs owning their missteps, bracing for a bit of a slowdown. Mandeep Singh of Bloomberg Intelligence joins us right now. Mandeep, you and I had this conversation earlier this morning. Let's explore it further. What is this new era? We've talked about the end of an era. What's this one?
Well, first of all, we're going to look back at this post-pandemic period, and really, I think the way these companies hire their, employees in terms of expanding their employee headcount, this is going to go down as one of those phases where really these companies, I think, acted to an extent irresponsibly in terms of expanding their footprint. Yes, you can expect a lot of leverage from these businesses, but companies of this size, growing employee headcount 20, 30% every year, this is an anomaly, and we're not going to see this again anytime soon. But look, I think in terms of right-sizing the business, this is just a first round of layoffs. Guess what? If you're going to see competitive pressure on some of these companies, and I'm not saying it's going to happen to every large tech companies, but some of these companies may have to do an additional round of layoff if they find themselves to be in a weak competitive position going forward.
Mandeep, what kind of time frame are you thinking about?
Well, so again, no one knows the extent of this downturn. There is a cyclical element to it. My sense is, the digital ad companies, especially I think Alphabet, is in a strong position still. The revenue base is diversified, and they have to fix the cloud profitability, which I think they're trying to do here. Meta, nobody knows what the outlook is going to be going forward, for just the way it was growing before. Can it keep growing? I don't think so, because they're losing, impressions and time spent on their platform. And that is where, yes, they have done a 13% layoff, but guess what? It may not be enough, because it's not going to fix all their profitability issues. And, right now they're investing in Reality Labs, which is 2% of their revenue, but makes up 20% of their headcount. Same thing for Alphabet. Cloud is like 10% of their revenue, 30% of their headcount. At some point, they will have to right-size all these segments that are not making money.
Huge cuts, austerity hitting Silicon Valley in a major way. Mandeep Singh, Mandeep, love it. Great to catch up, as always. Bank of America's Jared Woodard looking for opportunities outside of big tech. He wrote the following: we see more risk ahead for these $70 trillion of tech growth and debt assets that proliferated over the last 20 years. We favour equally weighted equity indexes over market cap weighted indexes and favour small cap value stocks versus large cap growth. Jared Woodard, I'm pleased to say, joins us right now. And Jared, you also prefer the rest of the world over the United States. So can we start there? Why the rest of the world?
Well, John, when you think about the big equity indexes, you think about where they're concentrated and what the big risks are that they face in a world of higher interest rates, potentially higher trend inflation, big macro pressures. That's not a world in which, very expensive growth stocks tend to thrive. And unfortunately, that's still the best way to describe the S&P 500. The rest of the world is exposed to other things, other risks, but not the kinds of risks that we think are going to be as urgent this year. And so whether it's emerging markets, especially outside of China, from a financial investment point of view, even Europe, even Japan, face some meaningful risks, but they don't have the kind of valuation pressure that is still, I think, a big headwind for large cap U.S. equities.
Jared, 3 words: outside of China. I heard those 3 words louder than anything else you said. Jared, we've come into a new year. China's ripped. Everyone's getting on board. And you just said outside of China. Jared, why is that?
I think that the most important message is that you can have exposure to the Chinese economy and to the benefits of Chinese economic reopening without already owning Chinese financial assets. I think this is especially important for dollar, denominated and U.S.-based investors. Of course, you want to have exposure to the world's largest economies and to those benefits, but it doesn't have to be within Chinese financial markets, because look, a lot of the risk factors that were on people's minds so much in 2021 and even last year, around accounting and transparency, good governance, never mind some of the other risks that people have known about for years. These are still live issues that haven't been resolved. You see bipartisan now support for a kind of a disentangling, both on technology and even wider economic applications between the United States and China. And so I think it's worth having exposure, but doing it in parts of the world that benefit in a major way, but without the same risks.
Two obvious places to look. One's EM, the other's Europe. Can we talk about Europe? Europe has ripped so hard off the lows of last year, and it's had a tidy rally as well to start the year too. Can we talk about Europe and whether it's just lucky with the weather and it's a trade, or whether there's something here a little bit longer term?
I think it's a tactically, even for 2023, a good trade. For the longer term, the same issues around, plunging, adverse demographics, lackluster productivity, the absence really of the kind of technology that can be transformative. Some of the big risks structurally haven't been resolved in Europe, haven't been resolved in Japan, and so I think you have to be nimble.
They're victims of bad energy policy. Most people would say that. Jared, bad energy policy has been good for energy equities over the last couple of years. And Jared, you haven't given up on that trade. Why is that?
Look, think about this image. It was in the press a lot last year of that wind farm in Germany that had to be destroyed because they needed to get access to the coal underneath. Okay, the fact remains that you have to walk before you can run. And unfortunately, it looks like some parts of the world have made big investments in the interest of running from an energy policy point of view, but without secure resources to get them to that future. In the sectors that make it possible, whether it's oil and gas, or I think nuclear power, or midstream service companies, there's a lot of places to invest these days. But we think that natural resources, doesn't matter what your politics are or what your policy preferences, you can need copious quantities of raw materials, mined and otherwise, to make the future happen, whether you're on the left, right, or center. And those things are still undervalued in the marketplace today. Look, energy and materials, throw in some industrials, and you had basically half of the equity market for much of the 20th century. Today, those sectors account for like 10 to 15% of equities. And we think that there's some mean reversion from a structural point of view higher that has to happen. You have to recapitalize those sectors if you're going to have an efficient, productive economy.
Hey, Jared, this was thoughtful stuff. I appreciate it. Jared Woodard there of Bank of America. We are about 12 or 13 minutes into the session. Equities are positive 0.2%. I mentioned EM, emerging market assets recording their best start to the year since the 1990s.
I think China is quite pivotal. So that's the one we're watching. That's what we're focused on this year, that will allow EM to possibly outperform developed markets.
A conversation you do not want to miss coming up next with Robert Koenigsberger of Gramercy Funds.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, an exclusive interview with Esther George, Kansas City Fed president. That's at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
Emerging markets.
Emerging markets.
Long emerging markets.
The U.S. is not the only market in the world.
We're in the start of a dollar downtrend.
The emerging markets benefit from the weaker dollar.
China is quite pivotal.
Emerging markets assets are cheap, right? They had a very bad year last year.
There are some juicy yields to be had.
And they offer carry.
There's a great confidence around the outlook now.
You kind of can't fight that carry.
Emerging markets kicking off the year strong. Sovereign bond sales seeing the best start in a decade. A weaker dollar, China's reopening fueling demand as borrowers welcome the lower costs. Gramercy Funds calling for significant upside in the next 12 to 24 months. The firm remaining constructive in its Q1 outlook, expecting the destination to be worth the volatility. I'm very pleased to say that joining us now is Gramercy's Robert Koenigsberger. Robert, great to catch up with you, sir. It's been a while. A lot of people are outside of this trade wondering if they should chase it. You're in it already and have been riding this wave for the long time. So let's start there. You've got a different decision to make. Do you stay in it? If you choose to trim some of the winners, how do you redeploy that capital?
That's right. Good morning, and thanks for having me again today. So look, I think there's a tension between FOMO, fear of missing out, and also climbing the wall of worry. And, I think we've got to go back and look historically at the dislocations that we've seen in emerging markets and see some of the returns that have come out of those. And, over the last 25 years, we've had like 11 of them. The peak to trough is down like 20%. The recovery takes about 8 months, and it's typically been like 27%. And then 12 to 24 months over that, after that, you see very strong returns, like 30 to 50%. So from a historical perspective, I think it's hard to stay out here. Now, one of the themes that we vetted in our top down this year is volatility. And, we expect there'll be volatility due to liquidity, due to policy uncertainty, due to supply and what have you. So that's where, Jonathan, we've talked in the past about having the ability to be tactical and to be able to move around, not only from a top-down perspective, but from a bottoms-up perspective.
Can we factor in China as well, Robert, just to jump in? Because China's reopening story has poured gasoline on all of this as well. Can you tell me about how you think the characteristics of China's reopening might be different to what we experienced in the West and what that tells you about where you want to be off the back of this?
Sure. I mean, I think, and I think we talked about China in the past. A lot of the focus was around the property sector, and the property sector, I mentioned it because it's like 25% of the GDP. And I think a lot of the concerns around China and what they may or may not do in 23 were perhaps alleviated a bit in the fourth quarter of 22, when I think they acquiesced, they blinked. The support program that's gone to the property sector to support the economy gives you a sense that that China, the China sovereign is behind it. I'm still of the camp that there's still a lot of pent up demand in China, demand to get outside of China, to travel and what have you. So I think we're going to see tailwinds from China in the reversal of COVID.
Let's say you were smart, like you guys were, and you picked up the debt of a Chinese developer at 7-8 cents on the dollar, and that's back to about 70. Robert, do you stick with that?
Yeah, that's a great question. And so it's a perfect example, Jonathan, of being able to be dynamic. So for us, we picked about 4 different baskets of Chinese property developers. The first one you mentioned, if you take something like Country Garden, it was trading around 7 or 8 cents. It is trading around 70. The asymmetry has gone the other direction. But interestingly, the second tier, third tier companies that are going to restructure, and part of what kind of announced in the fourth quarter is kind of the green light to restructure, they're still trading at like 10 and 20 cents. So, that's the opportunity to be dynamic, to move from the 70-cent security down to the 13-cent security.
You said they blinked. Can we just build on that? Because it's only a year or so ago people said China was uninvestable. Why do you think they've blinked? Why are you so convinced that this is a policy shift that is sustainable?
Yeah, and I'm not going to say that broadly about Chinese investing, and I agree with your previous guest that you don't always have to get exposure to China through the local market. But when I say they blinked, we have to go back to the Evergrande crisis. And if you remember, everyone was worried, is Evergrande going to be the Lehman of China? And what I think the Chinese government attempted to do was isolate Evergrande and then insulate the rest of the sector. But the entire sector was trading at 5-10 cents. The sector was frozen. This is 25% plus of the GDP. So when they blink, I talk about, the massive amount of support, and one could even argue was the equivalent of a Chinese TARP program in order to support this sector.
Robert, what was impressive about you guys last year is what you chose not to be invested in. You went into the year without Russia, without exposure to that story. It wasn't like you had to race to cut exposure. You did it ahead of time. Can you tell me whether that was your best decision, what not to own, as opposed to what to own?
Look, and I think that takes you into the whole debate about, passive versus active management. And, I think over the past, 5-10 years, passive and beta has been easier to hold on to. But your example of Russia and Ukraine is a great example. I think it exposed people to losses, I think maybe 800 basis points of loss, just because it was in the index. And one of the problems of when something's in the index, it's risky not to own it, right? I hear managers say all the time, well, we have no risk because we're flat to the index. It reminds me when we started Gramercy back in the late 90s, and the JP Morgan Emerging Market Bond Index had an 18% weighting to Argentina. It wasn't, whether you owned it or didn't own it was a huge thing. So yeah, I think 2022 was a big part about not only what you owned, but what you didn't own.
Well, let's build on that. There is this phrase that you've used, this paradigm of non-payment in high yield, sovereign high yield. Robert, where do you think that's going to show up this year?
Yeah, Mohammed and I and the team in 2020, as we huddled up around COVID and all the implications, one of the themes that we identified was this notion of a paradigm of non-payment, and that there would be certain sovereigns that would have adverse effects because of COVID, and we've seen this great balance sheet transfer, resource transfer from sovereign balance sheets to corporate balance sheets, and we thought that would play out, quite frankly, earlier, 20 and 21, and it did to a bit in Argentina and Ecuador and what have you. But remember, there was a tremendous amount of global liquidity in 20 and 21 as well. So what we saw in 2022 is this paradigm of non-payment starting to play out, places like Sri Lanka and Ghana and what have you, and these stressed sovereign balance sheets not having access to the capital markets. So that's created actual default, and securities have gone down and traded like default. So we believe 2023 could be the year where investing in the recovery of this paradigm of non-payment could be important.
This is fascinating stuff, deeply thoughtful. Enjoyed the outlook too. Robert, let's do this again soon. Robert Königsberger there of Gramercy Funds. Equities up just a little bit, much more so on the Nasdaq. Let's get you the trading diary. Coming up, existing home sales at the top of the hour. Fed Governor Chris Waller speaking at 1 p.m. Eastern, followed by President Biden at 2 p.m. Look out next week, US PMIs on Tuesday, along with earnings from Microsoft, followed by Tesla on Wednesday. Fourth quarter GDP on Thursday, and another read of the US economy to round out the week. From New York, that's it for this week. Enjoy the weekend. From New York, this was the countdown to the open. This is Bloomberg.